Hello everyone, we are from Group 8. Today we are going to present about Introduction to International Trade.
We do have five team members, which are Ramya, Kumbheshwari, Lavanya, Angleshwari, and Nur Rafiqah. Now, let's go to the presentation.
Hi, good day everyone. My name is Ramiyah Tamilchelvan. My metric number is 264268. Today I am going to present about theory of international trade. International trade theory is simply the theory explaining international trade, or these are the theories that explain or justify why a country or company do international trade. How a company or country can profitably carry international trade. Primarily, there are two types of international trade theories. The first one is classical country-based theories, and second one is modern firm-based theories. First one, classical country-based trade theories are the historical theories evolved since 1500 onwards. They are more from the country perspective, rather firm or company oriented. Hence, they are also called country-based theories. Following are the classical country-based theories. The first one is mercantilism. This was one of the earliest theory of international trade, and it came around the 16th century. As per this theory, a country should grow its reserves of gold and silver by encouraging export and discouraging imports. The theory implies that a country should have a trade surplus with export more than the imports. Many nations between the 1015s to the late 18s made a progress using this approach. This nation but put a restriction on imports, some things that we refer to now as a protectionism. Even though it is one of the earliest theory, is still relevant in the modern era. Countries such as Germany, Japan, Taiwan, and more still encourage export and discouraging imports. This country follow protectionist policies as well as provides subsidies to the domestic industry so that domestic industry remain competitive. The second one is absolute advantage. This is the among the best theory of international business. Adam Smith, in his book The Wealth of Nations in 1776, challenged the validity of mercantile theory and raised serious objection. Smith's story talks about the country focusing on producing an item that it can be manufactured more provisionally than other countries, with each country focusing on producing what they do the best. The result is a boost in the effectiveness. Unless the mercantilism, Smith's theory says that the government should not regulate or restrict the trade between the two countries. Rather, the trade should depend on the market factors. Smiths argue that gold and silver should not determine the country's wealth. Rather, the deciding factor should be standard of a living citizen. The third one of a classical based theory is comparative advantage. Smith's theory was a better, but it was not very practical. The argument against it was a country may be effective in the producing both the items or the other country does not have an absolute advantage in either item. In order to provide a resolution to this issue or shortcoming, David Ricardo introduced the theory of comparative advantage in 1817. Ricardo said business can still take place even if one nation has an advantage in making both the items. In such a case, the comparative advantage came into the play. The focus of comparative advantage is a relative productivity difference, while the absolute advantage focus on absolute productivity. The last in the classical based trade theory is Escher-Hoylein theory. We also call this theory factor proportion theory. Both comparative and absolute advantage theory does not tell which item a country should produce. Rather, the two theories assume that open market will help nations realize the items they have an advantage producing. Eli Acher and Brito Oilin in the early 19s came up with a solution. They maintained that a company should focus on producing the item that uses factor land, labor, and capital, which are in abundance in that country. If a country uses the factor that is at abundance, that it will help bring down the cost of the production. The second one is modern firm-based theories. These theories came up after World War II and were largely developed by business school professors and not economists. To address the need of the companies, the professor came up with the modern firm-based theories. Following are the modern firm-based theories. The first one is country similarity theory. Stephen Linder, a Swedish economist, came up with this theory in 1961. It explained the concept of intra-industry trade as Trade. As per this theory, the people in countries that are in same level of development have similar preference. Linda suggests that the companies first produce for the domestic market. Later, the same company can find a foreign country in which it can export the same product. The second one is product life cycle theory. One can find this theory in almost every college textbook. The credit for this theory goes to the Raymond Vernon, a Harvard Business School professor. This theory, which came in 1960, says there are three stages in every life cycle. These stages are new product, maturing product, and standardized product. The theory assumes that a country who came up with the new product should product produce that product. This theory also explains why the US was a manufacturing success after World War II. The third one is global strategy rivalry theory. Economists Paul Krugman and Calvin Lancaster came up with this theory in 1980s. This theory focuses on how companies can get a competitive advantage when competing against global firms in the same industry. The theory says a company gets a sustainable competitive advantage by developing a barrier to enter. Such barriers may be research and development economies of scale, intellectual property, rights, ownership, and more. Porter National Competitive Advantage Theory is the last in the modern firm-based theory. Porter in 1990 came up with a theory to explain national competitive advantage in 1990. The theory says that competitiveness of a country business segment depends on the ability of that segment to come up with the innovative items, progress, and more. Porter explained why some nations have a competitive advantage in some segments.
I am Kumri Segaran and my metric number is 264533. Now I am going to explain about international trade and the economy. For many years, the United States government encouraged American businesses to sell their products to other countries in overseas. However, in recent years, Americans actually are buying more goods from other countries than they sell to them. When a government wants to encourage trade between their countries, they write trade agreements. When they want to discourage trade agreements among their countries, they introduce trade barriers. A trade agreement is just what it sounds like. It's an agreement among two or more countries that increase trade by making it more beneficial for both parties. A trade barrier is an obstacle to trade between two or more nations. As a good example of a trade barrier is a tariff or a tax on imported goods. Tariffs make more expensive to buy and sell imported products and therefore discourage trade. Now we will look at a couple of examples of trade agreement from around the world. The Asia-Pacific Economic Cooperation, also known as the APEC, began in 1989 to promote economic growth in trade cooperations with the Pacific Rim. It's the first meeting included Australia, Brunei, Jerusalem, Canada, Indonesia, Japan and South Korea, Malaysia, New Zealand, Philippines, Singapore, Thailand, and the United States as well. These countries discuss ways to cooperate in the fast-growing regions. Over time, the APEC has worked together to move goods quickly and safely between member countries and create new jobs. To make a new policy, all the members countries must agree. This is called the consensus. Another example, the European Union is or EU. The EU was created in 1993. Its purpose is promoting cooperation in both economic politics among European countries. The EU has a common currency known as the euro that are not trade barriers between countries in the European Union. In 1994, the United States, Canada, and Mexico agreed to the North American Free Trade Agreement, which is NAFTA. The agreement removes most trade barriers among the three countries. Overall, the agreement has increases trades among the three countries, especially for agricultural products. In general, citizens and politicians in the United States disagree about international trade. Some Americans want the United States to increase trade with other countries in order to lower labor costs, while others prefer more trade barriers to protect US industries and workers. Historically, trade barriers have been shown slow economic growth and development. As an example, is this the Great Depression of the 1930. In response to the financial crisis, many countries around the world increased the tariff to protect their industries and to earn their by taxing other countries. The result was decreased world trade, which ended up hurting the country's economies as they could not sustain themselves without money being made by selling goods to other countries. That's all for me, and this is my explanation about the international trade and the economy. Thank you.
Hello sir, my name is Lavanya, daughter of Saravanan, and my metric number is 265097, and I will talk about risk in international trade. So, to start with, when an organization desires to engage in international financing activities, it takes an additional risk along with the opportunities. The main risk that are associated with the business engaging in the international finance, including foreign exchange risk and also political risk. Also, other than that, the risks are involved such as transportation, intellectual property, and credit risk, currency risk, and also a lot more that the person has to deal with. So, to these challenges may sometimes make it difficult for companies maintain constant and to make a reliable revenue. So this risk can obstruct the smooth running business, and hence appropriate measures need to taken to limit their effect. So there are 12 commonly faced risks by business involved in international trade. So the first risk involved in international trade is credit risk. So credit risk or counterparty risk is a risk that of not collecting an account receivable. Like there are ways business expanding to global market can protect themselves against this risk. This is a common risk that even not international trade business also can face this. I mean, like local businesses. Second risk that involved in international trade is bank risk. When assessing and managing bank risk, country risk and bank risk are essentially inseparable because country's risk profile is largely influenced by health or otherwise, or its financial system also might be an influence for this. Since the bank reflects the financial position of an economy, it is not difficult to imagine the natural alignment between the two elements. Third risk that involved in international trade is country risk. These are risks that relating to all events in the country of the buyer or seller, which are likely to affect the payments or supply of the goods. Risk related to foreign countries include political, social, economic components, including the regulation of exchange, control among buyers may sometimes, the lack of foreign currency, adverse changes in government policies and laws. So the fourth risk involved in international trade is document risk, where it may be lack of documents necessary for international trade, such as invoice, bills of lading, or insurance. It can be also lack of sales contract, which does not cover certain points by the law or codes in force. And other than that, changes in exchange rate risk is also a risk that involves in international trade, where changes in home currency or foreign currency affects the prices of realization. If the home currency is devalued, the competitive capacity of the exporter is enhanced. So, if the foreign currency is depreciated, there is a considerable reduction in the exporter's competitive strength. So, the sixth risk is interest rate risk. So basically, interest rate risk is uncertainty exposes a firm to the following types of risk. Borrowing on floating rate bring uncertainty relating to future interest payments for the firm. So the floating rate makes the borrowing cost decrease in the value. Next, government regulation risk plays an important role in risk in international trade. So this is undeniable because all countries have their own legal system and adopt different imports and export laws. In any relationship, however cordial and long-standing it may be, differences are likely to occur at any time. Other than that, insurance risk is the risk of change in value due to deviations between actual and expected insurance costs. This means the risk that actual outcome deviates from the expected outcome due to, for example, a higher claims frequency, larger average claims cost, one or more major claims, or higher outcome of insurance costs compared with estimated provisions. Other than that, intellectual property and piracy risk plays an important role in this international risk involved international trade. Also, because intellectual property is the risk that third parties may make unauthorized use of the business strategic information, such as like studies, research, agreements, contracts, client lists, trade secrets, and many other things related to this. Or property that directly or indirectly affects the value of the business when doing business internationally. So this risk increase tenfold because the difficulty of remotely defending the business's rights to this property. So the next risk is price risk. Price risk is the value of a security or investment will decrease. Factors that affect the price risk include earnings volatility, poor business management, and then price changes. So the best way to mitigate this price risk is diversification. So other than this risk, shipping and transport risk plays an important role, which transport costs constitute generally plays a major part in the invoice. So any change in transport cost affect the competitive edge of the exporter. So the last risk that I'm going to present is transfer risk. Transfer risk is trade that a local currency can't convert into another nation's currency due to changes in nominal value or because of specific regulatory or exchange restrictions. So that's all the risk that involved in international trade that I know. Thank you. That's all.
Hi guys, my name is Murugan. My Mantic number is 264563. Now I'm going to talk about my part, which is roles of banks in international trade. Banks are important facilitators of international trade. Banks play a key role in forming bonds of trust between buying and selling agents. Agents executing transactions in international markets. Local banks are intermediary banks outside the country, which assist in affecting international payments and the receipt and payment for goods and services by local people. Moreover, banks play a very important role in foreign trade through the provision of the financial structure and instruments necessary for the conduct of business transactions between foreign buyers and sellers. Bank ensure safety and transparency in the flow of documents and money. Buyers, who called as importers and of goods from abroad, the sellers, who called as exporters, will want to be assured of payment, and as a buyer, one would want assurance that all the terms and conditions of the purchase agreement are kept. This requires then the bank come in to broker an agreement and work as intermediary between the importer and the exporter. In addition, banks guarantee payment for around a fifth of world trade. The banking sector thus plays an important role in international business. Today, almost all the banks have formed collaborative alliance and established correspondent banking relationship with banks in another country to better serve their international business community. Finally, banks play a major role by providing assistance in many ways to facilitate international trade business, which encompasses financing working capital requirements, financing capital goods, identification of potential markets for international trade, identification of buyers and sellers, facilitating payment for international trade transactions, issuing import letters of credit, pre and post shipment financing, and guaranteeing payment under letter of credit issued by other banks. Let's see some example roles of banks in issuing letter of credit for international trade. The most common instrument used for payment and shipping control is letter of credit issued by the bank of the buyer in favor of the seller. After the bank of the buyer approves the issuance of the credit, the issued letter of credit is sent to the advising bank that establish the authenticity of the instruments and inform the beneficiary of receipt. The advising bank may confirm the letter of credit after checking the terms and conditions for payment by adding its own guarantee to that of the issuer. Commercial banks facilitate trade and payment of funds through documents. After all of the terms and conditions for shipment and quality standards have been checked, via the presentation of proper documentation, the issuing bank pays the seller for the goods. This is how a bank playing role in international trade. Thank you. That's all from me.
Hi, my name is Nur Rafiqah binti Hashim and my metric number is 2677741. I will talk about on how government agencies give an assistance in international trade in Malaysia. There are two government agencies that provide an assistance in international trade group in Malaysia. First is called Malaysia External Trade Development, or can be said as METRADE. METRADE is an agency that is responsible to assist the Malaysian companies in order to succeed in international market. Second, it also serves to promote the Malaysia external trade with a particular emphasis on the export of manufactured and also semi-manufactured of product and services. Third, it formulates and implements the marketing. The next agency is called Export-Import Bank of Malaysia Berhad, or can be said as Exim Bank. Exim Bank is a bank that is delivered an effective financial and also technical solutions for cross-border ventures of international trade in Malaysia. Even though it is a subsidiary bank in Ministry of Finance, it also promotes the reverse investments and export of strategic sectors such as capital goods, infrastructure, manufacture projects, shipping, value added manufacture products, and also facilitate the entry of Malaysian companies to a new market. Other government agencies that provide an assistance in facilitating in international trade growth in Malaysia, but I only listed a few in this slide. First is a Ministry of Finance. Second is called Malaysia Investment Development Authority, or can be said as MIDA. Third is Majlis Amanah Rakyat, or can be said as MARA. And the last one is called National SME Development Council, or can be said as NSDC.
Thank you so much everyone for watching. We hope we have gave good explanation about the international trade. If you like our presentation, do like and share to your friends. If you want to know further information, ask in comment section below. Thank you.